What's up, money lovers? Welcome back. Today we're going to be talking about Alibaba stock, which has just been getting punished. It just every time you think it can't go any lower, it keeps dropping down all the way to $133 right now, down 50% over the past year. At the same time, while many won't touch Alibaba with a 10-foot pole, people like Charlie Munger have doubled down. They've bought a lot more shares. So is Alibaba a great value right now, or is it a value trap? Today we're going to look at their last earnings report, what they're doing with their business, how they're diversifying, and how these things will play out. And lastly, I will tell you guys what I'm doing with my shares of Alibaba. First up, let's touch on some highlights from Alibaba's September quarter 2021 results. Alibaba continued to firmly invest into their three strategic pillars of domestic consumption, globalization, and cloud computing to establish solid foundations for a long-term goal of sustainable growth in the future, said Daniel Zhang, the CEO. Now, back in 2018, Zhang had said that he thinks cloud computing will grow to be Alibaba's largest and most profitable segment. So we're still in the very early stages on their cloud segment. Obviously, the majority of their business is still the domestic consumer section, although we're going to take a look at that and how they are diversifying internationally and into Southeast Asia more. So the global annual active consumers reached 1.24 billion, a quarterly net increase of 62 million consumers. Revenue grew 29% year over year, driven by performance of our diversified businesses. So from that, everything sounds great, but then we'll get into the nitty gritty. There are definitely a lot of pros as well as cons to be aware of here. So while revenue grew 29% year over year, as well as annual active consumers, their adjusted EBITDA was down 27% year over year. I think this was what was most shocking. The year over year decreases were primarily due to our increased investments in key strategic areas that have exhibited robust growth in operations, as well as our support to merchants. I'm going to touch on these segments in a minute, specifically Taobao deals, as well as Lazada, which are in the early stages, but I think could be very strong segments of the business for Alibaba. So here's a Forbes article from April explaining that China's e-commerce used to be focused on the top two quartiles of consumers, the affluent and upper middle class, but today the fastest growing segment might be this third quartile, which is composed of middle and lower middle class consumers, and this is where Taobao deals comes in. So a lot of this pivot has to do with the availability of internet through cell phones and just the ease of e-commerce. So Pinduoduo is a big player in the space that's been giving Alibaba a run for its money. And they actually have more active annual consumers, 788 million versus Alibaba's 779 millions as of the end of 2020. But this is a huge market, and they've estimated that there's 350 million potential customers that fall into this category of middle class and lower middle class. So Taobao deals follows this consumer to manufacturer business model, which enables the manufacturer to sell the product directly to the consumer. So it's definitely something to keep an eye on. Who will win out here, Pinduoduo or Taobao deals owned by Alibaba? But either way, you could look at this as a new potential market for Alibaba, a good way to diversify their business away from being so heavily focused on just their one segment of business that they were prior to this. So you can either look at it glass half full like that, or glass half empty that, they're going to be facing a lot of tough competition. This is a new industry, probably will have lower profit margins and a lot of growing pains as it is still relatively new. And if we look back on its history, Alibaba bought a controlling stake in Lazada in 2016. In 2018, Lazada was the largest e-commerce operator in Southeast Asia, but by the end of 2020, as we saw from the other article, they are losing that share to Pinduoduo. Now, Lazada is also a relatively new venture for Alibaba away from their core business, and they're focused on e-commerce in Southeast Asia, and they followed the footsteps and business model of Amazon. So one of their big competitors is Shopee, and if we take a look at their users, most of it comes from Thailand and the Philippines, but a significant portion from these other Southeast Asian countries as well, Indonesia, Vietnam, Malaysia, and Singapore. And then when you compare that to Shopee's active user base, Shopee has pretty significantly more active users. If we compare Indonesia, they have almost 100 million versus Alibaba only 22 million. And then Alibaba's biggest segments are Thailand and the Philippines, bringing in 36 and 34 million versus Shopee has 50 million in Thailand and 33 million in the Philippines. So definitely some competition there. Alibaba in their if we go back to their quarterly report, that they expect 2022 fiscal year revenue growth of 20 to 23%. So they also revised their expectations, which were higher prior to this earnings report. So while Alibaba is branching out into these new markets, which they will definitely face competition, they're definitely still the biggest company. They still bring in the most revenue and have the most at their disposal to help try and win out in these markets. And as we can see, Lazada recorded over 82% year-over-year growth, despite this competition from Shopee. Now, cloud computing. In the September quarter alone, cloud computing revenue grew 33% year-over-year. So there's definitely a lot of positives here. And as I mentioned earlier, CEO said in 2018 this will become the biggest segment of the business. So as long as the cloud computing segment continues to grow, that's definitely a very big positive for this company. So they are doing share buybacks, and they bought back approximately $5.1 billion worth of shares in the September quarter here. So the China commerce retail business is definitely slowing down. That's a big fear. All these companies will have a hard time continuing to grow due to the slowing market conditions in China, as well as more players entering this Chinese e-commerce market. But it's good to see then that Alibaba has, branched out, and they are looking into markets beyond China. So just to summarize all of the key points really quick, and then I'll tell you guys what I'm doing with my shares. Alibaba's market share in China is shrinking due to a slowdown in the Chinese economy overall, as well as these new players entering the market and taking Alibaba's lunch. So that's definitely something to keep an eye on. Now, Alibaba's expanding into those Southeast Asian countries, so it's good to see that they're diversifying away from the core business that's increasing, but that obviously carries a whole lot of other risks. It's hard to operate in other countries, and they're facing competition there, and this will probably be lower profit margin businesses, at least for the time being. But with their Taobao deals, they are following this consumer to manufacturer business model, and it caters to this third quartile of China's population that consists of the middle and lower middle class that historically has not been targeted. And then they've got Lazada focusing on Southeast Asia. And China has the fastest growing middle class in the world. They're the country with a lot of these growth prospects, so even if there's a temporary slowdown, there should be no issue in the long run. The market should be big enough for multiple of these companies, whether it's Baba and JD.com. They should be able to both flourish in the long run. Now, some big positives you have to look forward to long term with Alibaba is that growing cloud segment, which could become the largest segment and most profitable segment of the business over time. People worry about this ADR structure with Alibaba and Chinese companies in general. I'm not too worried about it. I think it was blown out of proportion because this is nothing new. This has always been the way it's been. I don't know why all of a sudden it would be a problem. And yes, you do have the risk, obviously, of the CCP stepping in, imposing more fines, doing things of that nature. So you might have a couple extra risks as opposed to investing in US companies. So it's up to you if you want to take on that risk. I think that there are positives here. They're doing the share buybacks, expanding into these Southeast Asian markets, as well as the future of cloud computing. And, cons obviously would be that government interference and other competition in the space stealing Alibaba's lunch. This is a company with a much larger market than Amazon, and it's basically trading at where it was during 2019. So we'll see what happens. Now, what I'm thinking of doing with my shares is instead of continuing to buy and, seeing this red go down more and more every day, I'm thinking about selling my shares to buy a long call option or a leap, because I'm sitting at around $170 cost basis. So I'm figuring I could write off those losses this year and then buy an Alibaba call option for, let's say, 2023. I was looking at the $200 strike. So I may end up doing that, buy a leap call option on Alibaba. That way I almost have less money at stake, because I think it was, when I checked the other day, it was something like a $200 strike price. The premium was around $2,000. So then at worst, the most money I'd lose would be $2,000 versus right now, buying 15 shares of Alibaba cost me $2,000, and the call option would give me the right to purchase 100 shares. So let me know what you think of Alibaba in the comments below. Are you buying? Why or why not? Do you think that these other companies pose a legitimate threat to Alibaba, or will they recover? If you enjoyed the video, don't forget to like, subscribe, drop me a comment below. This is Vinny from the Investment Club, and I'll see you next time.